Hello, YouTubers, friends, compatriots, bootlickers, shills, desolators, peasants, vassals, minions, meat sacks. I'm a Useful Idiot. Welcome, and let's go back to the good old USA. And some of this stuff, of course, is global. But I'm going to do a three-part series that no one will watch because nobody likes this kind of stuff anymore. I'm going to do one on buybacks. I'm going to do one on negative interest rates, and I'm going to do one on the move to cashless society. So, hey, everybody out there, surprise me and watch my domestic videos, which don't seem to be that popular. But I'll continue to do them anyway for those that will enjoy them. So anyway, let's go on to this story about buybacks. And I'm sure everyone has heard about buybacks by now, particularly a Useful Idiot crowd. And what we have is the biggest buyers of this stock, and what's helped driving this record stock market surge upwards is all these corporations and banks that are buying their own stocks, and they are the largest buyers of their own stocks. I've heard all kinds of figures thrown around about 60%, something around 60% of all stock purchases. I'm sure it's probably higher than that are being bought by the corporations themselves. So let's try and spell this out as straightforward as I can so that it doesn't sound so convoluted. But what we have is earnings per share are earnings divided by the number of shares outstanding. So as companies' actual earnings decrease, the blow per share is lessened by reducing the share counts by using buybacks. And as revenue and earnings deteriorate, buybacks bolster share price by increasing demand and reducing the supply of the shares. And so we have a lot of revenue and earnings deteriorating, particularly in a lot of sectors, and they just hide it by doing these buybacks. And then it ends up like so much in our fantasy world economy and financial services, what used to be liabilities become assets. So another part of this is that share purchases and buybacks are part of the increasing financialization of the U.S. corporate sector, where investment in financial instruments crowds out other investments. And that's one of the criticisms against buybacks, is that it removes a lot of money that corporations and companies used to put into research and development so they would remain viable in the future and keep their edge. But now it's more important to just drive up the share prices and create this illusion that the company is highly profitable and it is at least stable for right now, but at a sacrifice of the future. But that's speculation. There's some evidence to support this so far, but in the long run, we're not really sure. In some respects, from everything I've read, buybacks can make sense to a certain extent, but to the degree to which they've been used to manipulate stock prices in this last 10 years or so has been something we should be concerned about. And so anyway, what are the reasons we have these stock buyback in general? It's the only thing keeping stock prices up. Pressure from shareholders that want to continue to reap these high dividends. Executive compensation is tied to share price, and that's something that's been discussed elsewhere. And if the only impetus and motivation that the CEO of a corporation or bank has is to drive up share prices any way possible, and will sacrifice a lot of other things in the company in order to drive that share price up, particularly because he gets a big fat bonus for doing that. And never mind that in a lot of cases, these big fat bonuses are achieved by these stock buybacks, and then by the time the CEO leaves, all the damage is already done, and somebody else gets to hold the flaming bag of shit. And increased global competition makes corporations and banks resort to these methods as well. And then there's a fear of long-term investments in product and services, like I mentioned earlier, not only research and development, but product and services and investment. There's no reason to do that anymore. And one of the reasons why we're seeing the quality of companies in corporate America deteriorate as well. But don't blame them for wanting to fear long-term investment in this environment. But everything, of course, is short-term. So short-sightedness. And then, of course, they use debt to buy these buybacks. That's one of the worst parts about this. They just go back to the credit markets and borrow the money in order to do all these buybacks. So let's look at some of the figures. We have from 2006 to 2013, we had $4.14 trillion in buybacks. So you get a good idea of exactly how much artificial stimulus is being put into the stock market and stock prices when you see those kind of numbers. 60% of the 3,300 publicly traded non-financial U.S. companies have been doing buybacks since 2010. So like everything else, if one's doing it, everyone's doing it, and everyone is doing it nearly. In 2014 alone, the amount returned to shareholders was $885 billion, and that's more than the company's combined net income of $847 billion. So once again, they're riding the edge, just keeping the numbers so close. But imagine the fact that the combined profit, net profits, were $847 billion. That you can shell out over that amount, $885 billion, to the shareholders, and that's in year 2014. And in 2015, we actually had a record number of buybacks, $1 trillion in buybacks, and that's over half of the $1.8 trillion in after-tax profits. So we continue to see those trends. And as I mentioned earlier, one of the things they're not interested in long-term investment, and that includes employees. And so we're seeing a lot of these companies shed thousands and tens of thousands, if not hundreds of thousands of jobs in order to achieve these goals. We've seen a massive attrition in the banks, particularly over the last several years. And Hewlett Packard, for example, shed 80,000 jobs just in order to shuffle the money somewhere else, and generally it ends up in buybacks. And it continues to be something that's precarious, and we need to keep our eye on because, for example, we have a company like Macy's whose profits are down by 30%, and they already have $7 billion in debt, and yet they still go out and do $1.5 billion in buybacks and borrowed money. So a lot of these companies are getting in deeper and deeper in order to buy more time and kick the can down the road, like so many other things in this economy, and so many other corporations and banks. And let's look at a little history about buybacks. Congressmen have called this practice a potential form of market manipulation. Well, yeah, no surprise there. I mean, if they're the only ones buying the stock and they're buying it at the top of the market, and that's another thing, they don't buy on the dips, they buy at the top of the market and keep driving the prices up, then certainly it is a form of market manipulation. And like so many other things, it's something that used to be illegal, and during the deregulation years of people like Reagan and Clinton, we find a lot of things that used to be illegal are now legal. And in fact, before 1982, companies were largely prohibited from buying their own shares, and that's part of the Reagan deregulation. So once again, you have the SEC is a captured entity. It is not not doing really any oversight over buybacks, even though they realize that it's manipulating and distorting stock prices. They've made it clear they have no ability to enforce its own rules and to prevent market manipulation from buybacks. And then, needless to say, when you have a zero interest rate or a negative interest rate, just opens the floodgates, and that's what happened in 2013 when $755 billion in buybacks were done, borrowing $782 billion at the zero interest rate. So this Federal Reserve low interest rate is only exacerbating this problem and encouraging these companies. So you have all these banks and corporations that park their reserves at the Fed and get free money and interest rates, and then they can also go out and do these buybacks and borrowed money and pay almost nothing to do it. So why wouldn't they? And even the big powerhouses, you have to look at a company like Apple. Apple is this powerhouse that's driving, the whole world economy and is such a success story. But in 2014, they did the most buybacks, $57 billion, just that one company, the most amount of buybacks in the S&P 500. And like I say, the drawbacks ultimately are, cannibalization. Innovation is thwarted. Cannibalization is encouraged. It slows growth, worsens income inequality, and harms U.S. competitiveness. Of course, reduces the workforce. So that's all the things that will unfold into the future as these buybacks continue. And it is a massive distortion of the stock market. And I guess that's my main point. A massive distortion of earnings, a massive distortion of stock prices, and a massive distortion of overall trends. And they may ride this out with no consequences, but should things deteriorate further, then this whole buyback phenomenon certainly will come back to bite them all in the ass, and that's something we all live for. I'm useful, idiot. Don't you be one too.